Today's episode is brought to you by Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 209. If you have any questions or comments, please feel free to tweet at me, shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Special thank you to our sponsors for today's episode, Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. And Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's Quarter, QUARTR. We're excited to host our first in-person event in nearly 3 years. The Planet MicroCap Showcase is back in Las Vegas on May 3rd through the 5th, 2022 at Bally's Hotel and Casino. It's time to see each other. It's time to network in person. Let's make it all happen in the entertainment and business capital of the world. For more information, please go to www.planetmicrocapshowcase.com. See you in Vegas. Now, for this episode of the Planet MicroCap Podcast, I spoke with Kyle Cerminara. He's the co-founder at Fundamental Global Investors. I've been following Kyle for a while now, and this interview was actually a few months in the making, and I was extremely excited to chat with him about Fundamental Global's investing strategy, particularly in microcap stocks. Co-founded with Joe Moglia, former chairman and CEO of TD Ameritrade, Fundamental Global is a private partnership focused on long-term strategic holdings, and we discuss just what that means, joining public company boards, and really the difference between activism and suggestivism. So thank you again for tuning in to episode 209 of the Planet MicroCap Podcast, and please enjoy my conversation with Kyle Cerminara. This episode is brought to you by Stream by Mosaic. You can find them at www.streamrg.com. That's STREAMRG.com. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream was built by Mosaic, and unlike any other transcript libraries, Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.com. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K Kraft. That's BOBBYKKRAFT. And joining me today is someone who has been running in the microcap circles now for a little bit. This has been a few months in the making as well, and I'm really excited to have him on here today. We're going to separate this pod from some of the other interviews we did, just in the name pronunciation, so I'm excited to welcome on the show today, Kyle Cerminara. Or for those who know, it's Kyle Cerminara. He is the co-founder at Fundamental Global Investors. Kyle, thanks so much for joining me today, man. How you doing? I'm great. Thanks for having me. Dude, appreciate you having me on.
You're making me want to get like a chicken parmesan actually right after this, to be honest with that how I pronounce that. But this is our first time doing an interview together. I've listened to a few of the interviews that you've done in the past, some great ones on great shows, but for those who may have missed those interviews or haven't had a chance to meet you yet and learn your background, where did your passion for investing begin? So, I've been investing my whole career. I started investing in college and ended up being lucky enough to get a position at T. Rowe Price early on. So right out of college, I went to work for Legg Mason, and then about 2 years into that, went to work for T. Rowe Price. Got a great position, right after the dot-com bubble burst in the late 1990s. Went to work for T. Rowe Price in 2000, 2001. And, what was pretty neat, like CNBC was just starting to get, going in the late 1990s. And, a lot of the portfolio managers at T. Rowe Price were sort of becoming superstars on CNBC back then. And, I was young. I was 21, 22 years old, just out of college, and got to work with many of them right out of college. So, I remember early on, as a 21 or 22-year-old being, recommending stocks to people who, a year or two earlier was idolizing on watching them on CNBC and talking about stocks. And then all of a sudden I'm recommending stocks to them, and we're buying, hundreds of millions or billions of dollars of stocks based on my recommendation, as a 22, 23, 24-year-old, was really neat. And got to, I was in the financial services sector, was focusing initially on lending companies, and then some of the big Wall Street investment banks, and migrated towards some of the financial technology companies, got involved in companies like Ameritrade and E-Trade and Charles Schwab. And then over time, the exchanges became hot, and the MasterCard and Visa came public. So got to invest in a whole bunch of really neat companies. Ultimately ran several $1 billion when I was at T. Rowe Price. Got to work with Rob Sharps, who is now the CEO of T. Rowe Price, or just he's been named as the CEO. He's the president and CIO, and I think he's becoming the CEO in the next few weeks. And just was an amazing experience. After that, I went on to work for Steve Cohen, who was also an equally amazing experience. Worked with some great people at SAC, which is now Point72, and it was a great way to get my career started.
I mean, we could do like 3 hours just on your career before co-founding Fundamental Global Investors alone. I mean, I'm sure everybody. I think even in the previous podcast, you've talked about that experience at now what's called Point72. So love to hear maybe some of the lessons learned from there that maybe you've now been able to use at FGI.
So, T. Rowe Price and Point72 are really interesting contrasts, because people, think of like, how could you have spent time at T. Rowe Price and then spent time at Point72? Because they're two very different types of firms. T. Rowe Price gave me the opportunity to learn how to think about things over multiple year periods, 3-5 years. Like, they don't really think about the quarters, and they don't think about, investing over the next few days or weeks or months is not something in the DNA of T. Rowe Price. Like, they take positions for long periods of time. And that's really how, like, my investment philosophy got started. I did really deep fundamental work. When I got to working with Steve Cohen and the team at Point72, what is now Point72, it's such a different philosophy, and it really helped me think about how, like, why stocks move the way they move, how important, short-term performance is, along with, it's not just, delivering fundamental performance over multiple years. You also have to perform as a public company over the short run. And, it really helped me understand, like, how people think about things, in the short run, quarter by quarter. It doesn't mean that public companies should plan for the quarter or plan for, data points, but that's just, it really gave me an understanding of, like, data point, like how important data points are to investors, particularly, faster money investors, and got to understand, like, why stocks move the way they move. And was an absolutely great experience working with Steve and the team there. I joined in 2007. We had a large position. Actually, one of my largest positions was Ameritrade in 2007. So we joined. We did very well in Ameritrade in 2007, and then in late 2007, E-Trade actually was one of the first companies that came into trouble with the financial crisis in November 2007. You might remember Ken Griffin and Citadel bailed out E-Trade with a multi-billion-dollar bailout, buying out their collateralized debt obligations for like 20 cents on the dollar. And we basically, we're very early on in understanding what was going on with CDOs. We, in late 2007, and spent the next 2 or 3 months building out a thought process behind how to approach the financial system, because if E-Trade had a problem in their CDO book, like, they weren't the only one. So 2008 was a great year for us, at least for, in the financial sector. We did a lot of great work, on our team, and was great to learn how to short and spend time thinking about not just buying stocks, but how to bet against them as well. I had a great 2008, really learned a lot in 2008, and ended up sitting, sort of back to back with Steve, about three or 4 feet away from him for a few years. And it was a great experience.
Listen, I have to ask, now that he owns the Mets, we were talking offline how you grew up in Hershey, Penn. I mean, does that make you more Pittsburgh Pirates or Phillies? And, like, how
Hershey
is that?
Is like, yeah, it's like dead set in the middle of Pennsylvania. It's, maybe a little bit closer to Philadelphia. So as a kid, I would go, I equally went to Phillies games and to Pirates games, but I grew up more of a Pirates fan than a Phillies fan. But I have to admit, I've started to really like the Mets now that Steve owns them. So,
hey man, they just made a nice hire the other day. I like that show, Walter.
Yeah.
I think that was the right move.
Yeah.
Bring a little stability there. But I want to go on one tangent before we get to FGI, and you brought up your interest in fintech and how you really focus in that sector pretty early on in your career. It's changed and is moving so fast. I mean, it's probably one of, if not the hottest sector right now. You're seeing some of the valuations, you're seeing some of the money flows into some of these deals right now. How would you say it's changed, and since you started covering it in the last, let's say last 2 years, it's just been going nuts, Robinhood and all that stuff.
So, 20 years ago, fintech was not quite what it is today. It's really sort of evolved over the last 10 years or so. I think if you go back 20 years ago, fintech was much more focused on payments, like MasterCard and Visa when they came public. There was sort of a group of companies that were more focused on payments, credit card processing. Ameritrade and E-Trade, like in the late 1990s, there was an e-brokerage space and some e-finance spaces, but they sort of got grouped in with the financial services sector during the sort of 2001 to 2013, 14, 15 period. So the financial services sector, like I spent most of my time like analyzing these companies as though they were financial services companies. rather than sort of getting caught up in they are like super high multiple businesses. Like I understand why people have done that now, which is why like we didn't get overly carried away in the multiples that some of these companies have gotten, to trading at. Like I think fintech's really important. Like the banking system, like the traditional banks and the traditional insurance companies and traditional brokerage companies have, they serve a really important purpose. They work with much larger accounts, and they, you're probably not going to plop $100 billion deposit with a fintech company. They're much generally smaller accounts and more driven by retail customers. But I think that fintech has really revolutionized financial services. They've made they've offered much better products and services, and I think you're seeing a convergence of the banks are starting to think about like offering better technology and better services to their customers. But the reality is that the bigger financial services companies generally like to focus on the much bigger accounts. They focus on, like if you're a wealth management account, they're going to focus on, a 10 or 20 or $30 million and above account. If you're a depository account, they're focusing on bigger accounts. If you're a lending relationship, they're focusing on bigger relationships. Certainly you can get a credit card from a smaller, from a traditional bank, but there is a large segment of the population that is not getting the types of services that they would traditionally want, and that's why like the Robinhoods have sort of evolved, and that's why the Ameritrades and the E-Trades and the those types of companies were able to grow so fast and take market share from the traditional brokerage firms, because people didn't want to pay. Back then, people were paying $200-300 a trade to trade at some of the bigger firms, and it didn't make sense. Now you can trade for free, right? And and you can trade for free everywhere now. You can trade for free at Bank of America. But so it's. I think we owe that to financial technology, that they've sort of made financial services products and more readily available and cheaper for everyone. Whether people like or dislike the companies, that's to be debated. But there's no doubt that financial technology has made better products and services and cheaper prices for everyone.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. This is going to sound like a classic CNBC question or Fox Business question, but like, do you still think we're early innings in fintech innovation and stuff, or are we starting to kind of see a bit of parity or maybe over frothiness? I don't know. I go back and forth in my head sometimes when I see some of the products and services out there that on one hand, I'm thinking like, wow, this was definitely needed and doing a great job. But then you start looking at some of the business models and you're like, what will eventually survive from this? Like, I'm not totally sure. And if maybe they're just riding the wave right now, getting the funding so that they can get through the wave. I don't know. What do you think?
I think we're not in the early innings anymore. Like, I think we've gotten through a lot of the early innings. I guess it depends what you're talking about. Like, if you're talking about, blockchain, there's probably still some early inning opportunities on blockchain. There's probably, blockchain there's a huge opportunity on blockchain to, if you just look at like transfer agency or like other things like that like our entire back office of our brokerage, firms need to be like reinvented using blockchain. And I think some of the larger Twitter accounts have talked about this, extensively. You've seen
that all the way. Sorry,
Yeah.
don't mean to interrupt. Like I could not
Yeah.
agree with you more on that point.
So like, I think a company like T0 is doing some pretty interesting things, and like I think they're the only one doing it, and it really hasn't been adopted as much as it should be. So I really find companies like T0 interesting. On the other side of the spectrum, do we need another robo advisor? Like there's a lot of them, right? So and you can get like rebalancing into 20 different ETFs is probably at this point, whether you're buying these 20 ETFs or these 20 ETFs, like the S&P 500 and a high yield bond fund and a treasury bond fund. And if you're doing it in sizable ETFs, quite frankly, I'm not sure that we need another one of those options.
I know I could not agree with that more. I believe I just talked about this with Michael Green on a podcast on here not that long ago, talking about how blockchain could change up some of the back office public company stuff listen, you're chairman of a couple of these and I'm a board member, what some of these costs are on the service provider side, where it's really restrictive. When companies maybe want to consider going public a little earlier to access capital markets, and then they see a bill like, oh, cool, it's going to cost me, what's that number again? Was that $200K just off the bat to be public? Like, like there's clearly something needs to change, like, because that's just ridiculous.
Well, the costs are high, but it's not only just the cost; it's also just how inefficient it's managed. Like it's hard to track your shareholders. It's hard to, there's so much inefficiency in the back office right now. So.
Yeah, especially when you're considering if you're wanting to just see a no-bo list or anything like all of that is just it's just wild. It's just absolutely wild. Mm-hmm. But so we'll come back. We might come back to some of this stuff because I think I really wanted to cover that with you because it's been one of those things where it's like you're getting hammered over the head almost every day with like a new fintech product or service that you're willing to try anything that might give you an edge, especially as a smaller retail investor. But it seems like there's been a lot, and it's been a lot of stuff. So it's been kind of interesting getting the feel of things.
Oh, I agree.
Yeah. But okay. So I want to get to FGI. So you actually just posted a great article on Substack talking about the story of how you met Joe Moglia, who co-founded Fundamental Global Investors with you. So love to hear that story of how you met him and then, just starting this venture that you're in this journey you're on right now.
Yeah. And I started the Substack because people, I get a lot of questions and I was just like, well, at some point, is there a better way to just have things out there than, answering the same question again and again? So, if you go to fundamentalglobal.com, the stories on, if you click on Substack, you can read it. But generally, so I met Joe back in 2001. As I mentioned, I was an analyst at T. Rowe Price. One of the first sectors I followed was the online brokers. It was post.com bubble bursting. I kid you not, back then, people literally talked about how people would never trade online again back in 2001. That was sort of the debate. Like people were going to trade with full service brokers. They were not going to trade with online brokers. There were 30 or 40 online brokers at the time of substantial scale. And Joe Moglia, who had sort of risen to the top of Merrill Lynch in the late 1990s, was not given the opportunity to become the CEO of Merrill Lynch in the late 1990s, and was offered the position as CEO of Ameritrade in 2001. Left Merrill Lynch, from being like the number 2 or 3 guy at Merrill Lynch, and came to Ameritrade when it had a $700 million market cap. So, was a small company. It's hard to imagine Ameritrade is a $700 million market cap now, but back then it was a small, company with a website, and they traded online for something like $19.99 a trade. They did stocks and options, and it had risen to fame. In the 1990s, it had been a huge performing stock because it was kind of like the Robin Hood of the 1990s. But by 2001, it was financially troubled. They were not making money. They were losing money. So valuing it was challenging. and it needed a lot of change. So Joe came in when the stock was something like $3 or $4 a share. I met with him shortly after he joined. He had a great relationship with T. Rowe Price, thanks to his position at Merrill Lynch. He asked for a meeting with whoever was going to cover the stock. No one wanted to cover the stock. I very much wanted to cover the stock as an analyst and a portfolio manager, and sort of made the case for why this was an interesting investment. Joe and I met for several hours in late 2001 in T. Rowe's headquarters. Back then, no one came to the meeting. It was just the two of us in a conference room talking for hours about what he was going to do with the company and all the opportunities. And there were 30 some competitors, and the industry really needed to consolidate to 2 or 3. And he really didn't care if he had to sell, next year, he would sell, as long as he did what was right for shareholders. But he thought that, he could go and merge, 10 of these together or 20 of these together, and the opportunity to cut costs was huge. So I spent a lot of time on the idea, recommended it to portfolio managers. We had an analyst run fund that was something like $10 or $20 billion, a huge analyst run fund. So I made it my largest position in the analyst run fund. And over time, we became their largest outside shareholder at T. Rowe Price. And he bought Daytech, he bought National Discount Brokers, basically eliminated 100% of the cost of those companies, kept something like 90-some% of the revenue. Fast forward to 2004, the summer of 2004, the trading volume slowed down, and the stock was under a little bit of pressure. Imagine being I had some really great picks in 2003-04 coming out of the stock market crash, like some of the exchanges and so on. But Ameritrade was one of the ones that I really had made a bet on in a big way, and it had come under pressure because trading volumes were weak in the summer of 04. And at the same time, TD Bank was pushing for further consolidation. Ameritrade had integrated the Daytech acquisition completely, and I really just started becoming annoying to Ameritrade, saying like, you really need to talk to TD Bank. So much so that I think pretty much everyone in the industry knew about this. Like I talked to anyone that would listen to me. Every large buy side firm, and all the, without naming names, like all the big buy side firms knew about it, and we were all sort of the view that this should happen. I ended up writing a letter to the board of Ameritrade and saying like I'd really like to have a conversation about this. And in February of 2005, I ended up presenting to their board on why I thought consolidation would make a lot of sense for them, why I thought TD Waterhouse was the perfect combination. And that summer, in I think June or July of 2005, they announced the combination. The stock, which shortly before that had been trading at something like $9-10 per share, I think got halted and opened at, I don't know, maybe $18 a share, $17-18 a share, and traded the whole way up to $26 a share. They paid a $6 dividend, that deal closed. And then right after that, Joe announced that he wanted to become a football coach again. So he had been a football coach, and he ended up leaving after the integration, and he stayed on as chairman, but he ended up leaving the CEO position and going to Coastal Carolina University to take he did a few intern football coaching jobs at like University of Nebraska for a couple of years to learn how to be a football coach again, and went to Coastal Carolina. And during that time, I was interested in starting my own firm. He and I had become like the closest of friends at that point, thanks to all the different things that had happened with Ameritrade, and we sort of had huge success, like through people questioning, how will Ameritrade be a good stock, and like I sort of stuck with it, and was I think very influential in helping some of those things happen. And by 2012, we agreed to start Fundamental Global together. And at this point, Fundamental Global is the majority of the capital is Joe's and my family capital, Moglia and Cerminara capital, and we have a few sort of relatives and friends that have invested with us. We just have bought some microcaps. I have, besides my primary residence and some cash and a car and a pontoon boat, I've got 100% of my net worth in Fundamental Global and the stocks that we own.
Absolutely. Thank you for sharing that whole story, and that was fantastic. So
yeah.
Is he still coaching at the Chanticleers, or is he since not anymore? But Coastal Carolina Chanticleers, by the way, for anybody, the Chanticleers, their mascot. So just in case anybody knows.
Yeah. So in 2018, he had some health issues that were publicly disclosed, and he stepped down from the head coaching job. He's still the executive. He's fine, by the way, but he stepped down as the head coach, recruited his successor, and brought in a fabulous new coach who's probably one of the hottest football coaches in football right now, who's done a fantastic job. And he's the chairman of the athletic department. So the football coach reports to him, and he's responsible for all of the athletic programs at Coastal Carolina, and is also, I think, executive advisor to the president of the university. So
nice.
When you go to Coastal Carolina, his face is on the football stadium, and I think they've named a few different buildings there, after the Joe Moglia field house, or I forget what the different buildings are, but he's really a big deal at Coastal now, which is a pretty nice. It's a really nice campus and a nice school. They've done a great job.
Very cool. All right. Well, then let's shift to FGI now. As you mentioned, the company owns a few microcaps in the portfolio. You sit as chairman on a few of those boards, as well as a board member. So before we get into some of the nitty gritty there, what would you say is the firm's general investing philosophy, and how did that lead you then to microcaps?
Yep. So, it's generally, I think most people would characterize what we do as like value with a catalyst, but it's not like in the traditional sense of like deep value. One of the things we've tried to evolve to is growing companies with good management teams. Like we originally were probably more towards like the Graham and Dodd style, cigar butt style investing, and I think very similar to other investors who've done cigar butt investing. What you really learn is that it's really hard, and you get one puff at the cigar, and it's better to invest in growing companies with management teams that are going to do well. So we've evolved that from and we still are very value conscious in terms of price that we pay. But we do like to be involved in the companies that we're invested in. So there isn't a company that we've invested in where we haven't had some significant role in either structuring the investment or on the board or in some way. So every single one of the investments we're involved in, we either are a board member or a senior advisor of the company or some type of role where we put we helped structure the investment. Like there's a company in Toronto that we helped put together called Green First Forest Products. That was actually a micro cap, $10 million shell in Canada that we basically merged assets into. I'm actually no longer on the board of the company because I thought another Twitter follower, Ignore Narrative, Mike Mitchell, would be a better board member. He was a huge shareholder. He owned something like 5 million shares of the stock. We own something like 25 million shares, but we thought that Mike, who was personally involved, he could really spend a lot of his time on the company, would be a better representative. Like he was really obsessed with lumber and really obsessed with Green First. I thought that even though we were really involved in putting the deal together, I thought he would be a better board member. I was the chairman of the company, and we were given the opportunity to have a few board seats, and I made the case for why Mike would be a better board member than me going forward, and we put him in place there. So
very cool. So tell me about this idea for when you're assessing a potential new investment? And do you go in with that mindset that would you describe yourself as an activist, a suggestivist, or activist, but like on more of the chiller side? There's so many descriptions for folks that like to not just make an investment, but also take an active role in the business. So how would you describe yourself? And was that something that you knew going in when starting FGI, that was how you and Joe wanted to go about doing this?
Mm-hmm. So what I've learned is that, so I in some ways I've been an activist in the past. Like I've run proxy fights. I don't there's easier ways to do things than the way we've done them in the past. And what happens is that once you've done this 13, 14, 15 times, you look back on them, you evolve and you change the way you do things, because the first time you do it, it's like you're naive and young and stupid and you do it the wrong way. And we've gotten better at doing it now. So, it's really not necessary to do it in the way that many activists do it. And we were probably more of like a traditional activist early on. With Ameritrade, like just starting with like Ameritrade before I got to Fundamental Global, I was very focused on like they should merge with TD Waterhouse, and I didn't feel like they were. So I wanted them to do that, and they weren't doing it. So but I don't know that I was necessarily like an activist with Ameritrade. I just was very suggestive of what they should do. Fast forward to when we started Fundamental Global, like we actually got involved and filed a 13D on a company called Magnatech. We were much more considered like an activist with Magnatech. Like I contemplated a proxy fight, and we ended up having a settlement agreement with them. I joined the board. We hired Goldman Sachs. We sold the company to Columbus McKinnon. That was a great investment for us. But I don't know that looking back on it, that the company, the company's board was like, they were interested, I think, in doing the right thing. And it wasn't necessary for us to be as aggressive as we probably were. So I think we could have done it in looking back on it, we probably could have done it slightly differently. It's just, I think when you're younger, you assume the worst. And as you get better at this, you realize that you can do it in a different way. So, similarly with the company called Iteris, we bought a big position. They're actually near you in Santa Ana, California. We bought a big position in Iteris. Actually ran a proxy fight. They had a staggered, not a staggered board. They had what's called cumulative voting. So you could, the way their board was structured, you could actually run a proxy fight, and if you owned like 7 or 8% of the company, win one board seat, just because you own 7 or 8%, because it's called cumulative voting. And that was interesting. So we were like, look, like we're gonna win one or two board seats. You should just put us on the board. Like, why are you having us go through the process of running a proxy fight? We're going to win a seat. Like, this is silly. It was frustrating to us that we had to go through that process, because we were gonna win a seat no matter what anyway, because we could have just voted for ourselves using cumulative voting. But once we were on the board, like we all got along really well, and like they were actually a good board and collaborative, and I think they would say the same thing about me. Like, we ended up being like the stock ended up going up a lot. They performed well. They ended up doing a lot of the right things, and I ended up leaving the board a year later with a several 100% gain in the stock, and we sold our stock. So it was a happy ending, and I didn't feel like I had to be like sharp elbowed, and so that's another example. Like, we ran a proxy fight against Ballantyne Strong. We changed the board up, and that's a great example of like when I got there, it's like, oh my goodness, like this is going to be a lot of work. Like, we had to do so many things, and I ended up having to sell subsidiaries and reinvent subsidiaries and recreate companies inside of it. And, it was just a lot of work, and now that a lot of that work has come to fruition, we've done some really great things inside of it. The stock price hasn't reacted as well as I think it should have, but that's the opportunity. And but it was a lot of work to get there. Now it's like how do we build that company for the future? Similarly, BK Technologies was a lot of work. Like there was so much stuff we had to do there. But now it's like, okay, well, they announced a buyback today, I think. And that's just sort of simple blocking and tackling, right? Like stock goes down, you announce a buyback, and you buy back stock. And if you have the cash to do so, and they have tons of cash, they have something like 14 or 15 million of cash, and I think the market cap got down to 27 million or 28 million market cap with 15 million of cash and minimal, no debt. So it didn't make a whole lot of sense where the stock was trading. I don't understand why stocks do that, but the microcap space is very inefficient and is conducive to people getting involved. I wonder, is it easier just for some of these companies to be, either be larger, be private, be sold? We sold Magnatech to Columbus McKinnon. Iteris has gotten bigger. They've been able to get the company larger. We think that that the microcap space, like these companies, really need to get larger, and or they should be perhaps there needs to be ways to minimize the costs.
Man, there are so many follow-ups that I have from everything that you just said. So I hope you have like 3 hours ready to go. So let's talk about, clearly, without having to dig in or ask a question about it, you like microcaps because you've recognized over the years that there is clear fundamental value in some of these businesses. And maybe there's just a bit of hair that you're like, you know what, I've done this a number of times. I know with me, Joe, with our team, we can come in and probably realize maybe some of that value or some of the things that are just in their way. So on that note, what are some of your specific criteria when when you found a Ballantine or a BKTI or even a Green First that you initially observed or was part of some general criteria that you're like, okay, these are things that we like, but we need to go in and do a couple more things. Love to hear that.
Yep. And I can tell you, like, some of the initial things that we really like, I would probably go back and say, you know what? If I was doing this all over again, like if people wanted to just, like if we were going to just create like the company that we did with the Tasca Capital, like to do Green First in Toronto, I would probably just go create that company today rather than trying to, like, we now know how. We have a team now that we can go create a Tasca Capital rather than trying to go take over a company by being an activist. And I think it's so much easier and cleaner to do it that way. So if I was going to do it again with some of these, I probably would just create a new one, and that would be an easier way to do it. And I think, if you look at like how Boston Omaha did it, for example, that's basically what they did. In fact, it was a suggestion we made to them was don't go run a campaign against somebody. Just go and take a $400,000 shell, inject capital into it, and make it larger. And Boston Omaha has basically done that, and I think they've done a good job with that. But you don't. There's so many of these companies. I know a lot of people have said like, well, they like to invest in these companies that are highly levered. Like we won't invest if they're highly levered. If they have a ton of debt on them, I know you can make a lot of money with tremendous leverage, but you can also lose it all. And I just am not interested in losing it all. So if it's excessively levered, like we're generally looking for companies that we can buy at a substantial discount to what we think we could, either liquidate it at. That's sort of like the starting point. And then we look for like, some interesting business inside of it that we think, could grow. We look for good management teams or something that we could bring in. I can tell you it's actually much harder than than it looks, and maybe it doesn't look easy. I think it actually looks really hard because it is very hard to do. And I think that running like people criticize a lot of the microcap companies out there. I think that like being a microcap CEO or CFO or board member, like I feel bad for so many of these microcap executives and board members out there, because they do take a lot of, like, the microcap investor universe is pretty harsh compared to others, and these guys don't make a ton of money and they take it on the chin, and it's a tough you see a lot of stuff, like you're running these businesses. So when we're looking for a business that doesn't have that much trouble, that has you have enough problems in the business already, like you don't need to have like a massively levered balance sheet. Like you could lose. You don't need like huge customer concentration. You don't need some major issue in the business that could hurt you. So the number one criteria is clean balance sheet, huge discount to where we think we can monetize the assets, but then ideally a decent business that we think we can grow, and maybe we end up selling that business and buying something new with it. But that's sort of where we start with. Like, a lot of what we're doing now is looking for well-established companies that are run by great companies that have good businesses that we think we can sort of deploy capital into and get for a reasonable value. That's what we've been spending a lot of time on recently.
Got it. I mean, there's no market cap threshold that you won't go over or under. You look at everything. I mean, GreenFirst, it was what, 10 million market cap when you got involved. Ballantine, I think, was like 60 million right now, if I'm not mistaken, something like that. So it doesn't really matter. You're not constrained by that by any means.
No, I mean, like I was saying, like, I think some of the most interesting things are taking these.
Nothing too small.
We can create something that's a $400,000 shell and turn it into a multi-billion-dollar company, right? So like we did that with GreenFirst. GreenFirst was, at one point, it had like a $4 million market cap, and now it's several $100 million market cap. So there's no reason why you can't take these small companies and turn them into huge companies. So that's intriguing when you can do that. I think it's neat when you can do that. It's basically, you've got private companies, private assets that would benefit from being public, of scale. I think that's where a lot of these microcap companies would benefit. Like if you have a $50 million market cap company that can merge with a private company that's got several $100 million of revenue, like those are the things that some of these microcap companies should be considering doing, right? Even if they're giving up, significant control, they should be considering, like, how do we scale by, really making this business larger. That's basically what we did with GreenFirst. Like we were 49% shareholders of GreenFirst, and we went from 49% shareholders to 10% share, 10% shareholders, because we wanted to make it a real company.
Right. I mean, you just alluded to my next question a little bit, because when you're engaging with the potential new investment, say, look, this is how we operate. We take a position. We want to be active contributors. Whether it be a board member, something like that. It's almost like you have to sell them a little bit, right? On you and your expertise. So, I mean, what is the main thing that you sell them on? Is it the vision? Is it like, hey, these are the things that we identified where we can really add value and help grow the business? What's that initial conversation like that maybe at least gets them like, okay, this is pretty interesting. Like we should talk about having Kyle join the board or something like that. What is that initial conversation like?
Well, we never are like trying to pitch people on like we should join the board, right? So
fair. I didn't mean to say it like that.
Yeah. Like so like I'm on to more boards than I'd like to be, and I'm directionally trying to get off of boards. So like I tried to get off the GreenFirst board. I tried to get off of the iTerra's board. I tried to get off of I got off of the Limbach board. Directionally, like I don't want to be on boards. Sometimes it's important to be on a board because it protects our investments, right? So if like I can get Mike Mitchell on a board instead, that's way better for me, right? Because I trust Mike Mitchell to protect my investment as well as me. But it's hard to find the Mike Mitchell that's going to because Mike Mitchell, I know he's going to protect my investment well because he's like all in on Green First. So I know he's going to be as focused or more focused on Green First than I am. But, to answer your question, we have a pretty cool team. Like Joe took Ameritrade from a $700 million market cap to tens of billions of dollars of market cap through 11 acquisitions and a sale to Charles Schwab. If you look at those 11 acquisitions, it's hard to find one that was a disaster. They were all really good acquisitions. You've got Daytech, you've got National Discount Brokers, you've got TD Waterhouse, you've got Scottrade, you've got Thinkorswim. You look at sort of the acquisitions he made, like Thinkorswim, Scottrade, TD Waterhouse. Then he sold it to Charles Schwab. It's like, man, this guy, in financial services, M&A is a legend. The stock price did extremely well. He did it. He made tons of money for shareholders. He took a $700 million market cap public company and turned it into tens of billions of dollars. Sold it to Schwab. Two of like the best financial services mergers in history: Charles Schwab and Ameritrade, and TD Waterhouse and Ameritrade. He's responsible for. He's got amazing leadership skills. And then he left and he went to Coastal Carolina, which was a football team that no one had heard of. They had like very few people in the stands, and he made it into like it was like the most, like one of the most watched teams in college football last year with like the BYU Coastal Carolina game. And there's some really cool things he's done in college football. He did it at Merrill Lynch. He's done it like on multiple organizations. So it's really easy to see how Joe, from leading organizations to M&A to operations, and then I've had a pretty cool investment career. I worked at T. Rowe Price. I worked for Steve Cohen. I worked at a Tiger Cub. I founded Fundamental Global. I actually founded a wealth management company and grew that to $2 billion and sold it.
Right.
So I've done some interesting things where I know how the T. Rowe Prices, the Wellingtons, the Fidelities, the Genesis, how they think. I know how some of the Millenniums, the Citadels, the .72s think. I know how the Tiger Cubs think. So I can kind of help people think about like, well, how is T. Rowe Price going to think about this? How's Wellington going to think about this? How's Capital going to think about this? How is the Faster Money going to think about this? Is that just noise? How do I deal with the sell side? Like, so we've been able to help some of these companies think about that. Like from a microcap perspective, that might not be as important as it is for like as you're trying to grow into becoming a bigger company. But it's been more important for like, we don't want these to be smaller companies. We want them to be bigger. So it's like for like a Green First, for example, that's relevant because they're now a several $100 million market cap company. To get to be, a multi-billion-dollar company someday, hopefully, like that would be relevant. Certainly for like a Haggerty, which is, a company that, HGTY that we just did, or for an OpFi, that's certainly relevant. And then, the rest of our team is guys who have great, financial expertise, insurance expertise, and so on. So like we've got sort of the whole, quadre of experience on our team, and it's been useful. Like we've run public companies. I've been on, I don't know, 10, 15 boards or something.
Right. Yeah, so. No. And the reason I ask is because as some, listen, my show, I'm like, how much I'm in microcaps, I get asked on a daily basis from management, from CEOs of other public companies saying, hey, we're interested in, I want to be a board member. Let me know if you have any companies that just, need board members or something. So I wanted to the reason I asked was I really wanted to differentiate what, most folks would deem as like, oh, they're just a professional board sitter, to someone who's like really passionate about the business and almost reluctantly taking a board seat in order to realize some of that value, cause that's a big, misnomer in the space.
So it's interesting because being in our shoes, it's not that fun to be on a board because it's honestly like a daily position. It's actually quite miserable. It's a daily position, like where you're thinking about like, hey, here's a position that we have that we're trying to like represent our interests, right? We're actively seeking, and when I say our interests, I'm saying like I want shareholders to do well. I get that like sometimes that like when the stocks go down, it's like, well, that's not happening. But that's the whole point of like why I do this, is so that stocks go up. Like, so you can say, oh, well, you failed because like this stock's gone down or this stock's gone down. Okay, got it. Jab me, got it. That hasn't worked. I get when people want to jab us because like something hasn't worked out well. I get it, but that doesn't mean that we didn't try, right? Like we're trying to make things work, and so it's painfully exhausting to be on a board and like be like we got to buy back stock, we got to pay a dividend, we have to cut expenses, we need to grow, like we need to cut expenses, but we need to grow. It's like there's just like a really complicated formula for doing all these things. People think like you can just turn around, like snap your fingers and sell a company. It's like you can't. Okay, it's very hard to sell a company. It is one of the most mind-numbing, exhausting processes to go through, and it's really exhausting. However, I've never had the benefit of doing this, but I imagine it must be fun to be on a board when you don't own the stock, because like but I've never done that. Like I've never had the opportunity to be on a board where I don't own the stock, because it must just be a dream. Just to like sit there and show up 4 times a year, but that's not us. Like it's not that fun to be on a board when you are, 10, 20, 30, 40% owners. It's like exhausting.
Let me ask you, I mean, you say like it's just exhausting being a board member. It's like very reluctant to even wanting to do it. But what's been the most challenging part about being on a board, joining a board, being board chairman? Love to hear all those challenges and maybe how you overcame some of those.
Look, the biggest things that are challenging is that you really have a complex situation of, you want to recruit the right talent to lead the company. You want to make sure you have the right strategy. At the same, you want to think about acquisitions. You want to think about mergers. You want to think about selling the company at the right time. You want to make sure that the communications of the company are proper. But doing so as a smaller company is hard, because if you want to invest money in the company, well, guess what? Your overhead's too high, right? So if your overhead's too high, you need to cut costs and keep it like a really lean budget. Well, if you keep a really lean budget, guess what? It's really hard to grow. So if you keep a really lean budget, it's really hard to attract talent. So like investors want everything, right? They want an overhead to be like super low. They want the CEO to make no money, but they want the CEO to be like incredibly talented. And they want like fast revenue growth where earnings are like crushing numbers, but then they don't want you to like invest, like they want you to invest for growth, but they don't want you to invest for growth. Like they don't want you to spend any money, right? So it's like a very complicated formula that's almost like you basically have to spend money to grow. And you have to invest to get good executives. Attracting the right executives can be challenging. So, convincing the right executive, like, hey, this is a good opportunity versus, working at your Fortune 500 company. The Fortune, like if you work at like Facebook or Google, you're making a lot of money as a middle management. Facebook's paying people $1.5 million in like pretty reasonable, or Google, or like they're not in huge positions. So try and attract that talent to come work at a microcap company as the CEO, right? And it's like, well, I'm making, $1 million a year at Facebook or Google or wherever, but I want you to come and work here. But, oh, by the way, the microcap universe wants me to pay you $250,000 salary. And it's just like, what? That's like what my assistant makes, or, like not mine, but that's what they might say to you. Right. So like those are the types of challenges you deal with, is getting the right talent, getting, getting board members that have skin in the game. Right. So, like that want to be just as active as you are. So, that's why like I like to do a lot of this work. But it'd be great to have people doing it alongside of us. Right. But not in like a nefarious way. It'd be nice if people wanted to do it like in a thoughtful way, like actually help us like create value for these companies. So it's great when like there's people that want to own shares, that want to do it like thoughtfully, and want to help us like make money for shareholders, and not be difficult. It's hard to find, it's hard to not be the only one sort of carrying the weight of like the board. So you face a lot of that. The things come up at these I think what is the company that owns QVC, I think, had a fire in North Carolina this week, and I was asked a couple of times like, what do I think about that? And I was saying like, look, like things like this happen, right? It's just part of business. Like I get that it's challenging, but the company probably has business interruption insurance. But guess what? Like I guarantee the board of that company had to meet this weekend to talk about it, right? And unfortunately, like, you have to, the first things you have to think about are like, well, like, are our employees okay? What are we going to do about those employees? Like, those are the most important topics, are like, but then you also have to think about like, well, what about our customer orders? Like, how do we deal with our customer orders? Our employee welfare is the most important thing. Beyond that, how do we deal with our meeting our customer orders? What are we going to do? Like, do we have insurance? There's so many different things that go on. Like it's December, what is today? December 20th or whatever. Like, how do we get an attorney on the phone? Like, that's going to work on this over the next 2 or 3 days. Like there's so many things that I'm sure that company unfortunately is having to deal with. And I feel terrible for them, but that's part of business. And that's part of like, companies are dealing with those types of things all the time. And from the outside, you don't realize the things that people deal with. So,
by the way, it's December 21st for anybody that wants to give us a hard time. We're recording this on Tuesday, December 21st. But, on those lines, I mean, just a fundamental question about, who you are and your personality. Do you love it? You must. You must love dealing with these challenges, because why else would you put yourself through the pain and the torture in some of these cases? Because I can only imagine it can be a friggin' pain in the ass some of these times.
I love it, but I also feel like an immense sense of responsibility, and I'm a committed, responsible person. So I feel like I'm not the kind of person that like bails on anything that I started. And I feel like I started to create value for these companies. I'm going to finish creating value for these companies. And that's what I'm going to do. Right. So it's a pain, but I'm going to like make sure that like what I started is successful at the end. If I can do it. Right. So like I'm very committed to making sure that happens. And because it's a passion of mine, like it is, like I am passionate about making sure that, like I started something, I really want to see this be successful. Like Magnatech was really easy. Like I got on the board, we sold the company. It went very smoothly. Iteris was very easy. Some of these are harder. They don't always go perfectly. But I'm going to I'm going to make it is my passion to do what I can to make sure that, if I can, now I'm not Superman. So like if things happen that I can't, that I can't fix, then that is what it is. But I'm going to do my best to fix everything I can.
In all your experience, thus far, working in the microcap space, being a board member, board chairman, what would you say is an investing experience that impacted you the most, or maybe even changed your career and how you think about the way in which you're approaching doing investments? Sorry, I always save the hardest question for the end.
Yeah. So, I think that when you realize like the people involved in these companies, like I think like a lot of times investors on the outside like see everything like in a 10K and a 10Q, and they're really focused on like numbers, and but they don't realize like there's like a family behind like every decision you make, and you need to make the right decisions for the business, but you also need to like realize like there's a community involved, and like sometimes the best decision for the company is doing the right thing for the for the employees or for the customer that doesn't immediately affect the bottom line like that day, but it might have like a really good impact on the company 2 years from now because you did the right thing for the company. And I think that's something that I've learned over the last couple of years, that when you consistently try and do the right thing, it might not be apparent to people on the outside, but people that you do the right thing for see it, and over time, you get the benefits of that. So I think that sometimes the obvious decision is not always in perfectly in a spreadsheet. I think it usually is like, I've always guided my decisions from a spreadsheet, and I think that spreadsheets are critical to making every decision. However, I think that what you find is that sometimes like doing the right thing for a customer is just as important as like like if that product that you delivered them wasn't perfect, sometimes it's the better thing to like give them the right product, even though it might hurt your bottom line that quarter. And it pays huge dividends down the road. So.
Very good. So let me ask before we we're kind of rounding the bend here, but I mean, is there anything that we missed, or that, as part of your experience working with microcaps and doing what you do, that maybe you'd like our audience to know about, or do you think we've covered pretty much everything?
I think that the microcap space is interesting. Like it's a neat community. There's a lot of people that know each other. I think the people that invest in microcaps do a lot of good work generally. I think that they sometimes jump to conclusions too fast about people, about companies, about fundamentals. I think they have some preconceived notions about companies from 10 years ago or 5 years ago that can evolve and change. So they need to be open-minded about that. I think that the microcap universe is neat because, unlike the industry-driven, multi-billion-dollar company, universes that are very, inflated, in my opinion, I think that you can find some incredibly deep values. You can have stocks that were trading at $10, 3 months ago and trading at $2 today, and there has to be some. When you have hundreds of stocks that are down 80%, there has to be some value in there somewhere, right, where you can make money. So I think that's what draws people to the microcaps. I do think that there is a pretty interesting opportunity to take these microcaps and make them much bigger. So like, it's one thing I'm kind of passionate about is like, is there a way to take some of these microcaps and merge like a $50 million market cap or a $30 million market cap with a $200 million revenue private company, or a $500 million revenue, like we did with Green First. Like, I think that was a pretty neat deal. And I think it really takes it to the next level. Cause I think that having scale of a $200, $300 million revenue company, like getting it to those sizes makes a huge difference. Like, I think that's a much more investable company now. And I think that you can get sell side coverage. You can start to, you can have the resources to hire better executives. Like, I think you really do make a big difference when you start to get into the several $100 million market cap. So I find it interesting to try and take some of these smaller companies and get them bigger. And I think it's something for microcap investors to think about. I think that thinking about Pink Sheet, OTC versus NYC, American, and NASDAQ is an interesting topic that people don't talk about enough. Because I think that like some of these companies that just put out press releases with numbers, like it's cute that like people find it attractive that like companies save money on their financials, but it's also probably pretty dangerous that they're not getting like real audit opinions or I think that there is some value in like the money that's being spent on real audit opinions and being complying with like NYSE standards and NASDAQ standards. So like I think some of that stuff's in there might be benefits to going to the Pink Sheets or OTC in terms of like cost savings, and I'm not completely against those things. I'd love to hear sort of the positives and negatives of those, but I think that people maybe don't they maybe get too in the weeds on some of these smaller companies in terms of allowing companies to do things that are pushing the lines of good financial reporting stuff. So we're trying to bring a little bit of like I'd like to bring like more quality to some of the microcaps, and maybe not have the reputation that all these microcaps have. And maybe that means that we need to go up market cap a little bit.
Absolutely. No, listen, that right there is going to be a topic for probably our next conversation, I would assume. But another question I had for you, actually, I have two more questions before I let you go here today. So the first one is, how do you think about your own reputation now? You're part of on a few boards. I've said this a lot of times now. Like what do you think folks think when they see, all right, Kyle and his team are coming in, they're taking a position, I'm getting a call from FGI right now. Like, here we go. I don't mean to project it because I know you're not like that, but like, what do you think in terms of how you're seen now in the space, or maybe maybe retail investors think like, oh, Kyle's going into that, what does this mean?
So, it's interesting. Like, the reason I got involved in Twitter was because I felt like I was really looking for a way to communicate with like larger audiences, where if I wanted to communicate with people, I could actually have one way that I could reach larger audiences and say, hey, if you want to know what I'm talking about, just go to at Kyle Cerminara, and if I want to post a Substack, I can post it there. If I want to post anything, I can just post it there. It's just the easiest way to sort of consolidate. I think that Twitter tends to attract like a lot of positive things, so you can really reach large audiences, but it also makes it such that like people like Elon Musk or Kathy Woods, like I feel like like the larger your Twitter account gets, like they're the extreme case, obviously. They've really they get like lots of positive feedback, and they get like the most tremendous negative feedback too, right? And maybe they bring some of that on. And when I first got involved in Twitter, maybe I brought some negative stuff on myself, unnecessarily, because I didn't really understand how to use Twitter that well, and I was kind of just learning. But in terms of like when we invest in a company, I think initially we started to make like some of like the activist hot lists and stuff, and I think people started to get bothered by us being a shareholder. Like I remember when we filed a 13D on a company, like they'd flip out and immediately start putting in defenses, and that surprised me. So like we've tried to take like a little bit more of that if we need to be difficult, we can be difficult, but I've tried not to be viewed that way. Like I think we'd rather be much more constructive as a shareholder than viewed as someone that's gonna just rip things apart, because there's really no value to the company of coming in and like ripping things apart. Like if you wanna, have a conversation with us about one of our companies, have a conversation with us. Like we're not like, I have no interest in, like, all I want to do is make these stocks go up. So if there's a way to make them go up that you think so, like, give me a call. Like I'll talk very thoughtfully about it. Like I don't want to, like, there's no reason to be a jerk about things. And I think that's one misnomer that people have with other companies, is like they think that like if we're coming in, like maybe like we're going to be jerks. And like, I just don't think it's necessary to be a jerk. Like I think it ends up costing the company money, and it hurts shareholders, all around. So, I think that a lot of activist shareholders have learned that over time, that you try to be, thoughtful initially. And I think that that's a better approach. And in terms of our reputation, like, Joe Moglia's got an amazing reputation. I've worked at a number of different places where I've had, a great reputation, obviously at T. Rowe Price, and I've had, good like I think most people that have worked with me would say good things about me. For whatever reason, there's people on Twitter that like to sort of nag, and that is what it is. But so.
Just bad market timing maybe for the most part. So Kyle, I apologize for even saving this question until, this late in the interview, but I mean, like I said, I wish we have 4 hours here, but I got to ask you about management, man. I mean, I'm sure you've come in and, with the best expectations of like, all right, we believe in this management team, but sometimes it doesn't work out. What are some of the things you look for? And have you had experiences where you had to, replace management or bring in folks that you believe in? Like what's been that experience like?
So we've unfortunately had to fire some management teams. I personally had to do it. It's never fun. I'll tell you, usually, I mentioned that microcap investors want you to pay these executives as little as possible and have as talented as people as possible. I think that what I've found is that you can attract some good talent to these smaller companies with equity and reasonable cash compensation. So like, pay for performance. And I think that that's a reasonable way for us to do it. But we've had to bring in, we've had to bring in new management teams at almost every company. And that's just is what it is. Like many of these smaller companies don't have the greatest management teams. It's hard to attract talent. So it's not unusual for us to change out the management team. In a perfect world and sort of on a go forward basis, I think management has become like one of the more important things that we look at. And we say like, we don't want to spend time changing management because it's a time consuming process, but we've worked with some great headhunters and we've worked with some great people in our network, to find good executives for the right role. But over time it's inevitable, like, whether it's bringing in a new CEO or CTO or CFO or chief operating officer, over time, just replacing management can have like a huge difference. And we've done it. And I think one of the secret sauces that we found is that, particularly in microcaps, is like paying people, significantly with equity, so that when the stock works, they get paid well, has been a good way to go about things.
I mean, do you tend to avoid founder CEOs because that's a much more difficult path? Like let's say you're going to that company, you see some things you like, but you're dealing with the founder CEO. Maybe that's, taking it to the best it can possibly be to their capabilities. And you clearly see that maybe brings fresh blood in might reinvigorate or change some things up. Like, do you tend to avoid that because it's just way more work and a lot more just stuff involved, I guess you'd say, or, are you not scared of those opportunities as well?
I think founder CEOs are some of the best. Like, I think,
agree, no doubt.
I think there's a special gene that goes into being a founder of a company and building something. And it's like, sort of your third child or fourth child in terms of, like some people take on positions as a job, and some people take on positions as like building something because it's like their child. And founders build something like it's their child. And there's nothing better than having a executive that treats the company like it's like they will walk through a wall to make it successful. And I think founder CEOs are like that. And I think there's nothing better than having someone that will do whatever it takes to make it successful, whether that's 2 a.m. or Saturday, Sunday, Thanksgiving, Christmas, like whatever it takes, like they will make it happen. And, it's like when you have young children and you have to change their diapers at 2 a.m, you don't think twice about it. And when you have a founder-led CEO, they don't think twice about it. Like there's no question that they're going to do the right thing for the company when it's their baby. And when it's someone that you brought in, like, it's just not their thing. They might move on. Like, it's just not so it's hard to find like that special chemistry with somebody when it's not their thing. No, sometimes you do and you get lucky. But I really like founder-led companies. I think they're great. I think that they get unnecessarily a bad rep. And I think that, sometimes it's hard to find the founder that can take it to the next level. Sometimes they're good at getting it to a certain size. But for the size of companies we're talking about, founder-led CEOs are great. And sometimes it's as much as like bringing in like a great president or a great COO to help them sort of professionally manage the company. But that's my thoughts on it.
Absolutely. And I asked it from the perspective more of like when you've had to maybe, go in and you knew going in, like we might have to change management teams, and like it just maybe being a situation where it was a founder CEO where you're like, I like that situation might sometimes be a little bit more difficult, than say, you came in and it was already a hired gun there. Right. All right. So I know I've been saying this, before I let you go here today, you've given some great advice already for folks that may not know you, maybe considering wanting to be more active in some of their investments. But, for those maybe that are new to microcaps and the current environment that we're in right now, what advice would you have for some of those folks out there that, look, microcaps have been getting crushed a little bit in the last few months here. So, love to hear your advice there.
I think that people that are interested in doing some of this would be better off like learning the companies before they invest. Spending time doing their homework, reading the 10Ks and the 10Qs. Actually doing like much more homework than just reading the 10Ks and 10Qs. Like really getting to know the companies. Not going into it with the idea of like trading. So. Like when I go into an investment, like when the stock goes down, I get excited because we buy more. We don't get angry, or we don't even contemplate like selling the shares. So I think that if you buy shares and then when it goes down, you sell shares, it's like, but that's fine. But it just shows you just didn't do your homework or you didn't have, if these stocks are going to go down at some point. Given the nature of microcap investing, like there's going to be big drawdowns in microcaps. That is the nature of microcap investing is there's big drawdowns. And I don't know of a microcap investor that hasn't experienced like a massive drawdown, and you have to be ready to buy and position yourself with it and have the conviction to do so. And that doesn't mean that you should just buy blindly. It means you should do your homework. And if you haven't done your homework, then you shouldn't be involved in them. So, maybe you should wait for them to have big drawdowns before you buy. So,
all right, I think that's a good place to end it. So, listen, before I let you go here today, for compliance purposes, you mentioned a few names, so just want to make sure that we address that real quick. So, wanted to check if you are obviously just for I think current positions, you're currently a shareholder still in Green First. I think you mentioned that you sold out of Iteris, FG Financial, of course, Ballantine, BK Technologies. Just to start with those, are you currently a shareholder in all or sold?
Yeah, I'll make it easy for you. So I own 6 stocks, and those 6 stocks were very large shareholders of them. And other than those 6 stocks, I don't own anything besides cash and my primary residence, a car, and a pontoon boat. So I have 6 stocks that are Valentine Strong, which is BTN, BK Technologies, BKTI, FG Financial, which is FGF, Green First Forest Products, which is GFP on the Toronto Stock Exchange, OPFI, which is OPFI, and Haggerty, which is HGTY. I own 6 stocks. I have all my money in those 6 stocks, and I have cash, and I have a house, and I have a car and a pontoon boat, and that's my portfolio.
So all right. Firstly, thank you for that. Last question on the pontoon boat. What's biting right now? Are you fisherman? I would assume you're a fisherman.
I don't fish that much. Like, we live on a lake in Charlotte, so I'll go out and I'll catch some bass. But
bass, okay.
It's a good bass fishing boat.
Gotcha. All right, man. Well, Kyle, this has been so much fun. Where can our audience go and find more information on Fundamental Global? Follow you on social media, the whole bit.
Yeah, I'm on Twitter at Kyle Cerminara or fundamentalglobal.com. So.
Very cool. All right. Well, Kyle, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. Happy holidays. Happy New Year. And I'm really looking forward to our next chat.
Thank you. Appreciate it.
Appreciate it. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.